Hey guys, my name is STANI KULECHOV. I'm the founder and CEO of Aave. Aave is behind of Ethereum, which is basically a decentralized lending marketplace, and have been in the Ethereum mainnet for a couple of years, a bit more. And I will continue basically the same decentralized finance topic that Gustav opened today, and I think there will be very interesting stuff coming up. So the topic is about lending pools and fractional reserve banking. Now, there's pretty interesting because kind of like fractional reserve banking is something that in one way, I mean, at least for me, I mean, it's like what banks are doing today, you know? Like when we created our platform, well, basically our decentralized marketplace, kind of like we tried to create something new that wasn't before, right? So we kind of tried to do something that was already wasn't there around, you know. We tried to do some things that banks are now doing and basically creating some completely new world. And today, when I'm speaking about fractional reserve banking, it's kind of like weird for me as well. But in one way, if you look at projects like, for example, ETHLend or MakerDAO, we are basically looking at traditional finance, taking those kind of like concepts and putting it into a smart contract-based systems, adding decentralization. So we kind of aren't inventing anything new, but we are just applying the technology in a very interesting way and trying to make things efficient and transparent. Now, quick detour on decentralized finance. So basically, I think what the word DeFi means, I mean, there's it's a hot topic at the moment. I mean, you hear about DeFi everywhere, on Twitter, on Telegram. I mean, it's one of the interesting things out there, and it's nothing new. I mean, there has been kind of financial projects on Ethereum for a pretty good time now, for a couple of years. But the very basic thing that's important for us is, of course, the equal access to finance, that basically we have a system that anyone can participate, so it's kind of resistant to censorship, you know. It's very difficult to see how it goes in the future because we kind of like decentralized finance doesn't work or live in a vacuum, you know. We just can't build something and say, okay, it's completely decentralized, so now what it means that I don't need to give a shit about regulation, you know. It's difficult to work in this kind of an environment. So, but the idea is there, you know, and in the behind. And of course that you control your own funds, you hold your private keys, thank you. And that's one of the part that basically you are operating and using a system that's non-custodial. So you are not trusting someone else to hold your finances. And of course, control of your personal data, so what you can actually contribute. For example, if you're taking loans, collateral-backed loans, why would you need to, for example, give information about your credits, or why do you need to give your email and so forth, if it's basically backed by a collateral? So I think that's part of decentralized finance as well. And of course, my very favorite is transparency, because I mean, one of the things that we have is basically a decentralized lending market, so everything's basically auditable by everyone on the blockchain. And that's not the case, for example, with centralized lenders, where you are actually trusting what they're saying to you, and whether it's statistics or how they operate, or what is basically market price for different kind of loans. So that's a very cool thing. And of course, because we are using smart contracts, we are able to mitigate, I'm not saying remove completely, but basically mitigate the counterparty risk. So kind of like when we're not putting trust on putting the funds on someone else's possession and trying to trust these guys, we kind of can operate in trustless environment. And one interesting thing is that we can actually reduce costs, which are pretty heavy in traditional finance, but it's pretty debatable. I think it's something that we can debate whether we will have basically less fees when we have decentralized systems, or we operate in smart contracts, because it's kind of like technology which is very novel. ETHLend is one of the examples of decentralized finance. Now, kind of the coolest thing is that we have developed the system pretty long time now. I mean, the very basics of Etlend is basically a marketplace. We connect lenders and borrowers together who can make collateral-backed loans. And Etlend was the first kind of like crypto-backed lending marketplace, but also kind of like not just basically decentralized or smart contract-based system, but actually in completely something new, which basically led to other kind of systems, for example, Compound, where you have like a money market, and you have basically MakerDAO, where you can collateralize to basically borrow stablecoin as well. And in our system, we have the similar approach basically. So users hold their private keys, and basically collateral is stored on the smart contracts. So everything is pre-programmed, and there's kind of like no surprises. At least there shouldn't be surprises, you know. We never know, I mean. But that's the kind of idea of a trustless, decentralized system. And of course, like the very, very important that I love to highlight is that the whole loan data is auditable by anyone. So kind of like it's interoperable by default, but also you can see everything. There's nothing to hide. And I think that's pretty interesting in today's economics. So just a quick glance that you get some visuals. It's basically, this is just a simple GUI user interface where basically it's run on smart contracts, and we have basically borrowers and lender coming, and borrowers are placing loan requests and suggesting basically what kind of interest they want to pay. If they want to, for example, collateralize a token and borrow DAI, Ethereum or USD pegged Ethereum. And basically then we have also lenders doing the same, kind of giving loan offers. So it's like two-folded marketplace. That's our kind of like focus, connecting lenders and borrowers and making them a secure system to initiate these loan transactions. Yeah, so going to today's topic is basically fractional reserve banking. And kind of like what we're doing now in Etlend, basically, we have a marketplace where lenders are actively funding loans. So we have basically borrowers who want to take liquidity, and they might propose, for example, I would like to borrow 1,000 worth of 1,000 DAI, for example, with let's say 6%, 8% annually, whatever is the rate. And basically, other lenders who are in the system or see this particular loan request, they're basically funding. So it's kind of like active thing. It reminds a bit of OTC activity, and kind of like the difference in what happens in traditional banking is that we do have peer-to-peer lending platforms and form of funding for the past years, but the most popular way to actually establish finance in banks is through a fractional reserve banking, which basically means that we have a vast amount of people who basically don't want to go and fund actively projects, fund actively, for example, consumers, and go into the lending business, right? Because of the time constraints and whatever, or knowledge, for example. And we're talking about, for example, consumers. And what fractional reserve banking does in its very good nature, there's a bad side of it, but I will not go into that too much today. What it does, it basically collects, as a bank, you collect funds from a audience, consumers, businesses, via deposits. So people are depositing into a bank and they're getting interest. And I mean, there used to be times when you got a lot of interest. Maybe in Europe in these days you are not getting that much, and in most of the banks you are not getting anything, right? But what the bank does, actually it takes those deposits and lends out to consumers, to businesses, and basically to gain interest. And the interesting part is that in normal upside economy, banks are actually paying part of the interest to the consumers and the people who deposit these funds to the bank. And what basically this allows is spark liquidity into the banks,
and vast amount of liquidity because there are more people who want to actually gain interest but don't want to go for the kind of like active borrowing lending cycle. And kind of like for banks, it means that they get cheap liquidity because they do not need to pay much. But for the depositors, the very interesting part is that there's a fractional reserve, which means that, let's say, if there's a 10% of reserve, even if you deposited the funds and the funds are lended out, what you can actually do is also withdraw the next day, because there's always in healthy situation reserve there that you can actually use. So not all of the funds are lended out, but from all of the funds that you are depositing, you will basically receive passive income. And that's the kind of like the whole technical perspective on the fractional reserve banking. And I think it's an interesting concept because it could, in the DeFi especially, because kind of like what we are doing in DeFi, we are trying to replace the middlemen with smart contracts, right? So basically we are trying to create systems where we have a, instead of we having like a middleman bank collecting the deposits and lending out to different entities or consumers, we're trying to kind of like put a smart contract in between and mathematics in between to handle these operations. And it's an interesting concept. I think one of the first kind of like fractional banking or reserve banking or money markets that has been done is by Compound, which is a good example where you can put liquidity into a smart contracts and others can basically borrow. So the borrower has instant access to liquidity, and the lenders basically, or the depositors, are getting passive income, whether those funds are lended out or not. The interest, of course, is much smaller than like active lending, what you would be doing, for example, in ETH by funding this peer-to-peer loans. But actually it removes a lot of friction for the borrower and basically gives passive income for the depositors. And also it removes the time associated to actually funding these loans. So I would say in what we are doing in DeFi is looking kind of like putting smart contracts in between and making things more efficient and more transparent. And the transparency is a very interesting point, and I will come back to this when we talk a bit about interest rates and LIBOR and that kind of stuff. So what we came up with at Aave is decentralized lending pools. So kind of like instead of having this two-folded market where basically you create the loan request or loan offers and then this will be matched, we basically created a kind of like a protocol where you could create a lending pool, and this lending pool is kind of like your fractional reserve banking kind of like, I would not say entity, but kind of like a smart contract where you could actually control with your governance model or however you want to structure your lending pool, the liquidity and all the parameters. So it's kind of like equivalent to what we have in the traditional finance, but kind of like done in a way that is a protocol and used by anyone. So in one way, anyone can become a bank and create a DLP. The thing is, like anyone, of course, like everything's subjective to regulatory. I think even like if you consider like project like Etland, MakerDAO, and Augur, I mean, like there's a lot of regulatory uncertainty, and kind of like what we're doing is kind of this so-called like legal ice breaking and trying to show that there's like when there's like so much decentralization involved, and basically maybe there should be a different kind of perspective to the regulatory questions. But the core idea in technical terms is that anyone can create, because it's a protocol, anyone can create this kind of liquidity pool. Let's say you are interested in basically creating a pool with certain collaterals. For example, you want to have OmiseGo and bunch of other tokens, let's say BNB, MKR, and basically you want to use those as collateral there, and then you want that the pool basically borrowers can borrow Ether or DAI. And you can set initial terms, and then after you deploy your pool, you can basically invite more liquidity there. And you and your liquidity providers can govern that particular pool. And different parameters could be, for example, the interest rates, the loan-to-value ratio. For example, if you want to have less risk in the pool, you basically have more over-collateralization. So instead of 200%, you could have 400% over-collateralization. And when people are creating these pools, like if you take a look at, for example, Compound, it's kind of like a similar model, but the thing is that you're kind of limited to what Compound has. And what we are trying to do is basically open up the system and seeing that, okay, this is the model that the whole kind of lending part of the DeFi is switching to. And we're thinking like how to make it as kind of efficient as possible. And when anyone can create this kind of pool, we have more competition and basically more transparency, and we get more different kinds of variations of pools, I mean, and different risk parameters. And I think that's the kind of like coolest part. And one of the things that these DLPs can do is join into a network. So there might be 4 pools, and 4 pools are joining into one network, and they might vote cross-protocol or cross-network for a base interest rate. And this is kind of like interesting thing because it kind of reminds a bit what happened with LIBOR. There's a good amount of banks out there that basically voted on the interest rate that they applied, that what will be the rate to lend out an asset, for example, today or tomorrow. And I think what this allows, and in terms of governance, is basically taking it into a wider circle than basically 5-8 guys deciding on how much basically you're paying for your mortgage or your car loan and so forth. And of course, interest can be calculated per block. And if you add some governance elements there, you can vote on basically what could be the interest rate and how often the interest rate could be voted. Or you can do basically a fixed pool as well. And of course, it's a multi-collateral system. So basically now in Atlant, we are basically single collateral. So you always have to create a new loan request or accept a different kind of loan offer if you have a different kind of collateral. And that's kind of like a game changer. And that's pretty much kind of the similar approach that MakerDAO has. And of course, the fractional reserve level is something pretty interesting because you can have 10%, you can have even 0, which is basically non-fractional, but you can also have 50%. So basically your depositors has more chances to actually withdraw the collateral from the pool. And of course, the network part is that you can basically create different kinds of networks, and you could even create something because the interest rate might be different. I could imagine that in the future there might be relayers in different parts of the world, and kind of like using, for example, there might be a relayer in Europe or for example in South America, and they might have different requirements. For example, some might have to do KYC, for example, and they have different kind of costs. So they could basically join a network and kind of like vote for a base interest rate. And I think part of the kind of like this decentralized lending pool is the governance. It's very important because kind of like when you have a protocol, like we used to build basically direct kind of like vertical approach products. Like for example, Eatland is kind of direct product to the consumer. I think we will build our own lending pools for our own users. But when we are building something that's in a protocol level that anyone can actually use them, implementing their own projects, the governance part is very important. And one thing is how we govern the pool parameters. For example, will the interest rate be 5%, 10%? And it's a pretty hot topic because, for example, if you look at MakerDAO, there's the variable interest rate, which is basically voted. So kind of like what we have had in our discussion is that some guys really like the fact that you have fixed interest rate, so you're hedged, especially institutionals. So if institutionals has a loan, basically that's within variable interest rate, they have to hedge themselves with the interest rate swap. And kind of like the coolest thing in the pools is that you can create any kind of lending pool. So basically, if you think something like Compound and you don't like something, and instead of basically forking that, you just can create your own pool, invite liquidity there. You might have basically already investors that want to lend out some particular collaterals and I mean particular funds, and that's a very cool thing. And of course, the other things that could be governed is the upgradability of smart contracts. I mean, it's very good that people trust us in the community, but I think when they're putting a lot of money and trusting our technology, I think they want to have a war, like if we upgrade some features or change smart contracts. So I think that's also one things that we're looking into the governance model. So the whole decentralized lending pool is kind of like a proof of concept that we have been thinking for a quite long time, but it's something that's our next pipeline. So it's very interesting, like how things have changed in the kind of like decentralized lending field. And of course, the governance in networks. I mean, I really like the governance in protocol level, because if you can govern and vote on interest rates, and basically there's not just, for example, 10 people deciding on what could be the kind of like protocol level interest rate, but there are cases where basically you might have 5-8 entities, they have their own pools, and they basically want to vote cross pools. And that's a very good use case for example, for institutional users. And when we have, the more people we have actually voting for lending pools in a wider field, for example, in a protocol level, we actually get an lending price, the price of actually lending funds, kind of in the same way that we had LIBOR in previously. And yeah, so I think during this talk there were a couple of interesting things, and I think what you guys can take home today is basically we are in an economy now where we have fractional reserve banking. You might not feel it, because when you go to a bank, you deposit your money there, they might not give you anything. I mean, and that's the case, for example, in Europe, because of the kind of economic situation we are when the central bank gives very cheap liquidity. But for example, the very basis of fractional reserve is that you just deposit funds, and if you settle with that interest rate, and that's okay for you, you don't need to do any work for it, and basically you can withdraw it any time. That's great, kind of like a comfort for you, and also affordable liquidity for the banks, and also wider sphere of liquidity for the borrowers. So it should technically go affect in the kind of like end consumer. And of course, idea that when we use smart contracts, we can add more transparency, decentralization, so we don't have the 9 guys in cafeteria in London City deciding upon interest rates, but we have actually everyone here or in the community who actually want to have their voice, they can use their voice. And of course, trustless execution, we try to reduce cost and make things efficient. So the kind of thing is that we're not saying that we are changing something, we're trying to make things just slightly better. Thank you, guys. I think there's a couple of minutes for questions. 4 minutes, yeah.
Mike.
Oh, it's pretty long.
So the point of fractional reserve banking is that you have a fractional reserve multiplier which is less than 100%, that hence the fractional. If it's larger than 100%, then it's not fractional or reserve banking. Can you explain how is your multiplier less than 100%?
Well, I think the fractional reserve banking, there's a couple of aspects. So basically you have the multiplier, but also I think it's also kind of like the technical possibility that actually in a way that you have 1 million worth of DAI, for example, and from that 1 million, all the depositors who are depositing the funds are getting interest rates and passive income basically. But from that 1 million, 900,000 could be lended out. So basically you have 100K there, basically kind of like sitting, but the idea is that even though it's sitting there, it's kind of like catching that, for example, if there's lenders who do not want, I mean, they want to withdraw, they can withdraw. But actually the multiplier question and the creation of the money, it's even bigger discussion that basically I need to kind of like spend some more time with you to answer it. Cool. Okay. If there's no more question, I think we're pretty much done, and I think the next speaker could come here. Thank you.